Want to pay the bank less interest on your mortgage? Let's talk about buying points. And no, not the kind that you earn on your credit card. Mortgage points are essentially prepaid interest. You pay a little bit more upfront at your loan closing in exchange for a lower interest rate for the life of the loan. Typically, 1 point costs 1% of your loan amount and will lower your interest rate by about a quarter of a percentage point. So if you're borrowing $300,000, 1 point is going to cost you $3,000 and will lower your interest rate by 0.25%. Now, here's the kicker. Not all lenders are created equal when it comes to points and what it costs for any specific interest rate. Different lenders will offer a different amount of points for any given interest rate. Now, here's where working with a mortgage broker really helps. Let me show you what it looks like behind the scenes. Okay, so I priced out a scenario in my system, and you'll see that there's multiple different lenders here that I priced it with, so there's lots to choose from. And I'm going to focus up here. These are the lenders that are willing to offer 6.625% as their par rate. Now, par rate just means the lowest interest rate available that is not charging any discount points. So a lot of times that'll have what's called a lender credit, and I'll show you here. This lender is giving you a lender credit of $708. So that is money coming back to you as the buyer to apply towards your closing costs, which is important to note because if you're more cash to close sensitive and you want to minimize your cash to close as much as possible, it might make more sense to get a slightly higher rate and get more of a credit back. And the inverse is true. If you're interest rate sensitive and you want to get a lower rate, you can pay more in discount points to get that lower rate. And not every lender is going to be priced the same either. So if you scroll down, say, let's look at this lender here. See what they're charging. Their 6.625 actually has a points cost of $1,296. So that's why it's important not to just fixate on that interest rate. Any lender can throw an interest rate out there to you and say they can get it for you, which is true. If it's available on this chart, they can get it for you. But what matters is what it's going to cost you. So someone could promise you, yeah, I can get you a 5.875, but then you get the paperwork and you see that it's going to cost you $15,485 for that interest rate. So really look at what it's going to cost you and if there's any lender credit coming back to you. And that's why it can be helpful working with a mortgage broker, because the loan officer with a broker can shop different lenders for you on your behalf and make sure that you're getting competitive pricing as well as the best product that matches your needs specifically. Now, here's some more things to consider. Buying points can be a smart move if you plan to stay in the home for a while, but it doesn't always make sense. You'll want to make sure that you're going to stay in the home long enough to break even on that cost that you spent to get that lower interest rate. For example, let's say you pay $3,000 to lower your mortgage payment by $100 a month. That's going to take you 30 months to recoup the cost from the savings in your monthly payment. So you're saving $100 a month. It's going to take you 30 months to break even. Let me show you how I did the math. In order to calculate your break-even time, you're going to take the dollar amount that you spent in points at closing and divide that by your monthly dollar savings in your mortgage payment. This will give you the amount of months it will take to break even in your spend. Now let's take a look at the math in this specific example. So you spent $3,000 one time to save $100 per month. You're going to divide that $3,000 by $100 in savings, and that'll give you 30 months to break even. If you're staying in the home for longer than 30 months, it might make sense for you. But if you're planning on moving in a year, then it might not make sense. You're going to be out of pocket with that extra money and you didn't even get the savings back. This is another reason I usually inform my clients about seller credits, because you can negotiate seller credits as a part of your purchase contract to buy down the interest rate. So you're using money that's not yours to buy the interest rate down. And that's always a smart move, because then there's no break even. It's not money out of your pocket, but you're still getting that lower interest rate. So keep that in mind when you're negotiating and you're shopping. If you want to learn more about the home buying process, you can download my free Home Buying 101 workbook with the link in the description. And if you like this video, please like, subscribe, and ring that bell.